Okay, good afternoon, Shanghai. My name is Ted Jadick. I'm the CEO of DNB Markets, Inc., DNB Bank's U.S. registered broker-dealer. I'm pleased to be here to host, I believe it's the final panel of the forum, with a very distinguished group of international ship owners. Quickly want to thank Nicholas and the entire Capital Link team for bringing us all together, and hope it's been an interesting and successful forum so far, and that you're looking forward to our panel. I'll briefly introduce our panelists. Jerry Kalogiratos is the Chief Executive Officer of Capital Products Partners, LP. John Dragnis is the CEO of the Goldenport Group. Bob Burke, Chief Executive Officer of Ridgebury Tankers. Aristidis Pittas is the Chairman of Euroseas Limited and Eurodry Limited. John Lycouris, the CEO of Dorian LPG. And Hamish Norton, President of Star Bulk Carriers Corp. We have limited time, so I'm going to jump right into the questions. And I'm going to ask a question that I'll ask several of the panelists to respond to. When we look at the Chinese market today, and with the backdrop of the pandemic and the ongoing trade and political tensions between the US and China, how do you assess the strength of the market currently and the outlook for the market from a demand for shipping perspective? And I'll start with John Lycouris, if you could address that, please.
Oh, John, you're muted.
John.
There.
Thank you, Ted. Our business is mainly focused on LPG, propane and butane. This business has been a very important building block in the Chinese petrochemical industry. It has followed very closely the development of PDH plants in China. It has supported the petrochemical industry as well as the retail industry. And propane and butane have been very important to China. Exports have been extremely strong for that country from the United States, as well as from the Middle East. And we have a very strong growth in this business going to the Far East. And I think it will continue for quite a long time to go.
Okay, thank you. Bob, would you address the same question, please?
Sure. You know, the U.S. trade deal with China is dollar-based. So, you know, paradoxically, as oil gets cheaper, the Chinese have to import more crude from the U.S. You know, that's the first stage of the trade deal, and so far they seem to have been able to stick to it. We all know that China is 2.5 times further from the U.S. Gulf than it is from the AG. So there's a real levered impact on the crude trade as each barrel gets moved out of the U.S. You know, on the downside, we have U.S. crude production. The exports this past year have been 3 million barrels. They've held steady, but they're topping out, and all the projections are that that will go down over the next year or two. So that will be an issue. There's less and less money going to the oil patch. You know, the oil patch is certainly capital constrained. You know, the permits in Texas are down 70%. We all know that the decline curve in the shale play is much steeper than a traditional well. Spending is down on the capital side at 50% in the U.S. Shale patch, so that's going to come off over the next couple of years, and it's not projected to come back to where it is now for the next 3 or 4 years. So it's going to be that'll be an issue for us.
Thanks. Could you also address the same question, please?
Sorry, was that you wanted me to address that question, Ted?
No, John Drag.
Oh, okay. Yeah.
I'm coming to you, Hamish.
Okay,
yeah.
Okay. Thank you. No, of course. I mean, from the perspective of, I mean, if you look at it also from the dry bulk perspective, you know, China is also a tremendous influence, and thankfully has picked up a lot of slack from the decrease in demand worldwide post the pandemic. I mean, obviously the year started pretty well, but unfortunately, currently a lot of the West trades were hit. And of course, it's very key that China kept up the imports, especially on iron ore, on soybean, on grains, and that has assisted a lot in, let's say, stabilizing, helping the market to stabilize from a dry bulk perspective. Similar impact from the container trade, and I think on the tanker side has been analyzed somewhat from Bob. I think obviously you cannot only have China as the engine of the world. You need the rest of the world also to start working again in order for the dry bulk market to improve further. We do have some increase in the fleet, but it's very, very key that you see that there is more and more going into in terms of imports, especially waiting now from the US soybean season. Last but not least, in this respect, we're seeing the inventories going up a little bit in terms of iron ore and steel. And this is also evident from the fact that steel exports have been subdued recently, although production is very strong within the country, within China. However, most of the steel obviously is going into infrastructure projects and maybe some stockpiling. So we do hope that the rest of the world can pick up the slack and help the market improve further.
And then Aristidis, I'm going to ask you to also address the same question, please.
Yes, well, it's been addressed by the other panelists, both on the dry bulk and a little bit on the container. I just want to say that whilst things seem optimistic because we all expect to see a strong recovery in 2021, this really depends a lot on how the pandemic develops. So it is not an easy call. It will depend a lot on that. We are very hopeful, both in the dry bulk and the container markets that we are involved with, that next year will be a much better year, just because we think that the measures taken for the pandemic are quite good and are going to bear some ground. And of course, the huge disinterest in shipping that we've seen, which has resulted in very little new orders being placed. So there is a very, very low order book in dry bulk and the container sector, which we cover, lowest than it has been during the last 20 years, at below 10% significantly. And if we do see this recovery that is expected and hoped for by the whole planet, shipping will have its role, and it will be it can be quite a strong recovery, something we haven't seen for some years.
Thank you. I'm going to shift to a new question. How would you describe the financing environment for your business today? And as a part of
That's not helpful.
Well, you can answer, Hamish.
Sure, I will take a stab at the question.
Yeah, how important is China as a source of financing for the industry, and will it be in the future? So I was going to ask Hamish and Jerry to address that.
Okay, so I'll start out. You know, the financing environment for Star Bulk is actually pretty good. It's helpful that Star is a relatively large company. You know, the banks that are still in the shipping business are focused on lending to their larger clients. And so we're seeing a lot of interest. And we're seeing a lot of interest from China, which I'll get to. But what I think is encouraging also is that we're seeing a lot of interest from the 4 major Greek banks in lending to Greece-based shipping companies. And so that's encouraging. But we've done a tremendous amount of business with Chinese banks and Chinese leasing companies. And, you know, and quite recently, we've done about $250 million worth of sale leaseback financings. that put some cash on the balance sheet on a net basis, you know, which we wanted to do just as a hedge against potential downdrafts due to COVID-19, which, you know, thankfully have not materialized. In fact, the business is going strong. You know, generally positive outlook both for traditional European shipping banks. The Greek banks that used to be in shipping got out and are now coming back, and the Chinese institutions, which we're doing business with in high volume.
Thank you. And Jerry, could you address that question as well, please?
Yeah, thank you, Ted. I do echo Hamish's sentiment. I think that while we have seen certain commercial banks exit the space over the last few years, and definitely fewer new entrants, on the other hand, for large shipping companies that have established track records and presence in shipping, let me say that we feel that it's not the lack of money, it's not the lack of debt that doesn't lead us into new projects, it's more lack of conviction. So there is definitely abundance of capital if you meet certain characteristics. And I wouldn't downplay the importance of reputation and track record in the market. But of course, consolidated balance sheets and size matters very much to most financial institutions. Interestingly enough, I think when with the outbreak of COVID, there was the sentiment that potentially capital availability as well as cost of capital would go up. There was a fear that NPLs in other business segments would drag capital availability downwards as banks had to shore up their balance sheets. But I think the massive monetary easing that we have seen has helped a lot. Although I think we're probably at the beginning of this, not the end. We still have to see how a number of commercial loans play out in the real economy outside shipping, in real estate and whatnot, or other businesses in the next few months. Because once let's say, the fiscal easing is rolled back, we might see more issues. But as a banker joked about recently, he said suddenly shipping is the good kid on the block. Everybody else seems to have much more problems than we have, and we seem to be quite stable, which is not something that you could say easily for shipping over the last decade. And coming back to Chinese leasing, I think by now it's a mainstay of shipping finance. The product has evolved a lot over the last decade. It's now a flexible product, especially if you have assets with long-term charters, but also spot assets. Importantly also, many of the leasing houses, they have experienced teams, they have built relationships. That's a very important milestone if you want to have continuity in this business. And I think for any large company, I mean, if you look at the Capital Group as a whole, Capital Maritime, CPLP, the cash business, we have different needs, different types of needs, and it's important to diversify your capital sources. So CPLP, for example, until a year ago was 100% commercial banks. After, if you want an opportunistic refinancing, similar to what Hamish described, and a couple of acquisitions, we are now 60% lease financed and 40% commercial bank. So I think a lot has been changing, and is going. And for us, at least, it's something that it's going to stay going forward.
Thank you. Okay, now I'm going to switch to some individual questions, and I'll start with Bob. What specific signs are you looking for that will indicate that we have a turnaround in the product tanker market at hand?
And I think on the product market side, we need more transportation. We need more airplanes in the sky. I mean, evidenced by the fact that, you know, the 7 of us are on a screen instead of flying around the world to meet. You know, I haven't been on a real airplane flight in 6 months, which hasn't happened to me in 40 years. Yeah, and the cars aren't on the road. You know, the refinery runs are down. The car miles are down. It's just going to take the pandemic coming out of the state it's in right now. I mean, it's fairly simple. Crude runs are down. The refineries in Northern Europe are off. The refineries in the U.S. East Coast are off, and all those refineries, you know, are fed by sea, by crude. So they're going to probably go by the wayside, or at least they'll shut down for the time being, or repurpose themselves to a more of a green structure. So it's going to be air travel and cars. I mean, that's what soaks up all the clean oil, and that it's going to take some time. We all know the order book is low across the board. It's around 10%, 8%, you know, 11. We see different numbers, but you know, I always find when people are looking to the order book for comfort, that means there's nothing on the near-term horizon that's going to give us any hope. So, I mean, that's always the story, right? The order book, that's at least a year out before you see the result of that, and that depends upon scrapping. It depends upon increase in demand. So I think when people talk about the order book, it's a sign that things will be bad for a while.
Is storage, how important a factor is storage on the product side right now, Bob?
It is helpful. I think that's more on the margins, and it's less for a long-term type of assistance. Yeah, the storage long-term helping is on the crude side when there's a big contango play. Yep. And contango is coming into play a little bit, you know, again on the margins on the crude side, because it's not steep enough to have a financial play. It's just steep enough to slow deliveries down. It's steep enough to keep ships weighted to discharge a little bit. But on the clean side, you know, the arbs drive it more than the storage. And the storage a few months ago was driven by capacity constrained shoreside more than anything else.
Thanks. I'm going to, ask you a question. Euroseas concluded a major vessel acquisition transaction late last year, including bringing in a new shareholder via a private placement of equity. And has this strengthened the company's platform to consider additional investments? And how do you see the timing of additional investments given your current outlook in the market?
Yes, thanks, Dave. Oops. Yep. Thanks for the question. We've done two things the last couple of years. The first thing is that we split the company into two companies. We separated the dry bulk vessels in Euroseas and spun them off in another company called Eurodry to create pure play companies. So we have two pure play companies. This was the right move. The market does not like mixed fleet companies. The investors want to invest in a specific category. And that was proven the day we did the transaction and we spun off the company, the dry bulk company. We had an immediate market capitalization, total market capitalization increased by 50%. So I think this really proves the point that investors want to look at specific companies. They also specific pure play companies, and I think that they also want to look at bigger companies than the size of our companies, and this is the next bet that we have to grow both these companies, both Euroseas and Eurodry, into bigger companies. Organically, it's been quite difficult to be growing in this last decade. This last decade has been generally even more than a decade, 12 years, has been a poor decade or 12 years for the shipping markets as a whole. We are at one of the bottoms and we would expect that with this disinterest in shipping that we are seeing from investors worldwide, not only for the stock markets, but in shipping, will lead to the next boom, because whilst I agree talking about the order book is not talking really short term, but it's talking medium term, 6 months, a year out. And I think, Bob, one of the reasons why we had this 12 years of bad market was the extremely high order books that we had up to now and we weren't talking about. So we are trying to grow the company. We are open to discuss merger possibilities or drawing in other owners. And this is something that we've been working on and we will continue to be working on. It's not easy when the stock is trading below NAV, but I think this is something that will change only when shipping companies have again good EBITDAs. We have to see good markets for a couple of quarters at least before we see valuations of shipping companies coming back to close to NAV, which would allow such deals to happen. So yes, I can't see any short-term actions, but I think midterm things should improve in all fronts.
Yeah. Aristidis, I'm going to just modify my comment about the order book. I think we're in real trouble whenever we hear that the big order book is manageable, or we can absorb it. Then I think it's really time to head for the hills, because somehow or other we've never been able to manage a big order book. It's just a disaster.
Yeah.
It's true, we cannot rely only on that.
Mm-hmm.
We need a good demand.
Yeah.
Okay, I'm back.
Okay.
Hamish, I'm going to ask you a question, if I may.
Sure.
Star Bulk obviously made a very significant commitment to the scrubbers to address the IMO 2020 regulations. At this point, and obviously it's still pretty early days, how has that played out for Star Bulk? You know, in terms of the cost savings, the return on investment, the payback, those issues, but also in terms of, you know, expanding or increasing commercial or chartering opportunities.
Well, you know, first of all, the scrubber investment, it was a lot of work. There were a fair amount of surprises along the way. I mean, these were expected surprises. We knew that we were taking on a huge job. And there were some delays, but we managed to get all the scrubbers installed by the end of the first quarter of 2020. The cost was as we projected. It was, you know, just about $2 million a ship, a little less. And initially, the payback looked better than we had expected until COVID-19 hit, and as Bob mentioned, caused people to stop traveling in airplanes, to stop traveling in cars, and basically made it very, very easy for refineries to produce low sulfur fuel for ships. And so the spread between high sulfur heavy fuel oil and low sulfur fuel oil narrowed quite considerably. And made the returns on scrubbers quite a bit lower, so that while the sort of spread we were looking at in January would have paid back the scrubber investment in well under a year, at this point the scrubber investment looks like it would pay back in about 5 years. So, you know, not what we were hoping for, not what we expected, but frankly, not too bad in the context of shipping. You know, a 5-year payback on a shipping investment is, under normal circumstances, pretty successful. And, you know, we found that it certainly helps us get chartering business. I mean, basically, we've got a substantial cost benefit, and it doesn't take much of that cost benefit to get a charterer interested. So, you know, if we keep 90% or 95% of the benefit and the charterer gets 5 or 10% of the benefit, that helps get the business. and you know, that's in the cases of time charters. In the case of voyage chartering, you know, basically the ship carries the cargo at the market price per ton, and the benefit
Right.
goes to us. So,
Mm-hmm.
but you know, basically the scrubbers technically are working just as we expected. It's a technical success, and you know, I think it will prove to be a financial success as well.
Thanks for that insight. John Dragnis, let me ask you a question about the setup of Goldenport. Goldenport's the only private company represented on this panel. Well, sorry, Ridgebury's private. Excuse me. The company was previously listed in London, but the family took it private some years ago. And I just wondered if you could speak for a few minutes about, you know, your thought process around public to private, and what do you see as the advantages of being a private company today, a private shipping company?
Sure. Thank you. You know, it was, I mean, today our group is involved in dry bulk, as I said before, containers, and quite a bit exposure in product tanks as well. So, you know, this diversification helps a lot, especially when you're a private group. So, notwithstanding that, back in late 2006, we floated the company, and we thought it would be a bit novel, and went to the main market of the London Stock Exchange at the time, and listed the company with HSBC back then. And actually, we were extremely happy with valuations, extremely happy with the demand. You know, PEs were great, and price to NAV was a strong multiple of price to NAV. So obviously, incumbent shareholders were getting a strong benefit. So I will not hide that the price incentive was strong back then, combined with a possibility to diversify the shareholder base and fuel growth. However, many years passed, and you know, markets were great, things were great, there was a strong demand, valuations were good turnover on the share. But at the end, towards the difficult years and leading up to 2016, where the company ceased being private, I'm referring again only to the dry bulk and container part of the group, and actually not all of the ships, but most of the ships at the time, when we decided to take the company back private. The reason again was price driven. The reason again was that we, especially in London, that didn't turn out to be a shipping hub for shipping stocks, opposite to New York, which became the main hub, and Oslo. You know, we thought we'd better maybe try to consider to double down, although the market was extremely hard at the time, and put more money on the table and take the company private. Now, looking back, of course, because back then it wasn't such an obvious call, looking back, you know, it was one of the best asset plays we've done recently, and today has helped us establish a very, very decent book value on almost all of our assets. So, considering that, you know, the timing, of course, in shipping, as I say, is very, very important. However, we intended to stay private, public. I like being, you know, being part of the public company, and I like the forums, and this and that and the other. But at the end of the day, valuation really wasn't there, wasn't what we needed, and that was a problem. And it was a problem that we thought the timing was good, first quarter of 2016, to stop with this, and hence privatize the company. Now, you know, I won't go into a long story about advantages and disadvantages. Obviously, when the share price is trading well, you can raise money and even be a benefit to existing shareholders and grow faster. But it doesn't work well with shipping's counter-cyclical investment profile. I mean, you need to invest counter-cyclical, and this doesn't perfectly match with the understanding of maybe a public investor. Although now investors are a bit more educated and they do understand that. But again, overall, you know, they like dividends when it's a good time, and then we need to, when you need more money to invest in a company in order to invest in assets when the market is very low, this doesn't work always very well. So overall, it worked okay for us, but I do understand a lot, you know, the benefit of having a public company and the ability to grow through mergers, acquisitions, like, for example, Star Bulk has done recently. So I do get that as well.
Thank you. Thank you. Jerry, I'm going to turn to you, if I may. You also, Capital Product Partners, also concluded a major vessel acquisition transaction at the end of last year, and significantly expanding your presence in the container shipping sector. Is this a sector you see the company continuing to focus on? And how do you see the investment opportunity landscape currently?
Thank you, Ted. We have currently, and after the spin-off, we led about a year and a half ago, we have currently now 14 vessels, 13 post-Panamax containers, and 1 dry bulk Capesize ship. So I think the container space offers a lot, and especially the post-Panamax segment, of what we're looking for. The business model of CPLP continues to be one of investing in assets with long-term charters and giving cash flow visibility. I think on the container side, especially large containers, you are able to find more of that compared to other conventional segments in shipping. So we continue to focus on containers. Market there has seen a dramatic rebound. I remember in May, for obvious reasons, effectively global trade came to a standstill. At the time, analysts were expecting a 12% contraction in global containerized trade. Today, this looks more like a 5% contraction. So market has rebounded strongly. There were a number of differentiating factors compared to previous crises. Liners could set capacity quickly as they didn't have so many long-term charters. Bunker prices came down, and that also helped with liners making more money. And we quickly saw also China rebounding in terms of exports. August saw a 9% increase in exports from China, compared to last year actually. So a very strong rebound. So all in all, that market by now has seen a recovery, not where it was back in January, but it has, I think, covered a lot of lost ground. As a result, also asset prices followed more or less. They did the dip, and now we have seen asset prices picking up. We do see opportunities from time to time. It's definitely a market where there are not many players, and it's a market where you have to be very cautious with design, sizes. But if you get it right, and given the lack of willing capital at this moment, you could get, let's say, higher than average returns. So definitely monitoring that side of the business. And having said that, containers will remain the main focus, but we also benefit from a relationship with Capital Maritime. Capital Maritime has a commercial and technical presence across dry bulk, tankers, crude and product, gas. So if there are other assets that fit our business model down the line, we will look at those as well. In the end, I think the question for us is deploying equity in an accretive manner, and you have to weigh projects the one against the other and make sure that you are deploying your equity properly.
Okay, thank you. John Lycouris, propane exports from the U.S. are up year on year, despite the U.S. crude production and soft natural gas prices. These volumes, and particularly those being shipped out to Asia, are a main driver for the freight market. How is Dorian looking at the development of that market, going forward or in the near term, given some of the weakness in the U.S. production statistics that Bob highlighted?
Yes, it has been a very interesting development that, as we have seen in other markets, there was a significant dip or anticipation of a significant dip in the second half of the year, in the first half of the year, I'm sorry, second quarter, as it was in other markets. And we did see the concerns about production and about exports, and also in the output from various export terminals. However, we have seen a great return of that market in the recent months. So we even though we were expecting a significant drop, we saw that the decrease in output or in exports has been up to date about 1% below last year, which was a very strong year indeed. So in this third quarter now, we expect that perhaps we will go much higher than what we did last year. And production seems to have normalized. We have also an increased infrastructure which has been added during 2020, and we think that will help not only from the natural gas liquids kind of extraction from the gas stream, but also it will mitigate the potential impact of the reduction, of the decline in crude oil production that everybody has been talking about. For 2019 through March 20, we had 0 U.S. LPG exports into China. Once the tariff waiver from for U.S. imports was issued by China, we saw a 24% import volume going into China from the U.S. This is a significant turn. It's like a turn of a switch that we saw as such a significant change in import volumes, and as things normalize, the propane volumes will continue to increase out of the U.S., we believe, and the new export terminals and export infrastructure is coming online. I think we will see more product moving toward China and generally to the Asian petrochemical complex as the infrastructure there is growing, because China has done a huge build out of infrastructure, PDH plants and petrochemicals, as I said before. The VLGC rates have remained subdued in the beginning of in that second quarter. However, they have returned to a lot healthier levels in this third quarter, and we look that perhaps they will continue for the rest of the year. That's about what I can tell you about the increase of trade of LPG towards the Far East.
So at this point, am I reading it right that you're not overly concerned with declines in U.S. production?
Not at this stage, no. There's actually, we have seen in third quarter and fourth quarter that there's going to be significant volumes. The inventories in the U.S. are at the highest they've been, near 100 million barrels of propane sitting around. We expect that the production, even though it's not going to be used domestically because of COVID issues and because of reduced transport, we will see that volume will be exported. Therefore, that will continue shipping being an active part of that export. And that's the way we see things moving forward.
Okay, you guys are, thank you, John. You guys are doing such a great job. It sounds like we kind of have some additional leash here for ourselves. So I'm going to throw out another question and just maybe ask people who, to come in with answers if they would like. In the current environment, thinking about, further consolidation within the industry, within the various sectors. Is the current environment and maybe the valuation issue is obviously important to the question, but is the current environment with what I guess is fair to say still a fair amount of uncertainty around how the pandemic will continue to play out? Does that create too much uncertainty for companies to consider consolidation type of opportunities? Anybody want to take a stab at that?
I'm happy to start and say that in the first quarter, I think there was too much uncertainty for us to look at consolidation, but I think now we have enough confidence in how the future is going to play out that we're quite prepared to look at consolidation opportunities. There is inevitably a difficulty in closing consolidation transaction when the share price is well below net asset value. But we've managed to do that in the past. I don't necessarily expect it to happen anytime soon, but neither would I be shocked if we're able to find an opportunity. It's a question of both sides being able to deal with an NAV to NAV transaction, for example.
Hamish, I think the large M&A deals are extremely difficult. They take a long time, and they're few and far between. I think more of the consolidation comes from commercial consolidation, where there were commercial pooling operations or the large pools that are in existence now can soak up some of the smaller operators or owners such as ourselves. We buy and sell ships constantly, and we put them all into pools because that's the most efficient way for us, and it also enables us to have the flexibility of selling assets when we want. It eliminates the NAV issue. It's extremely efficient, and it happens very quickly. So I think a lot of the consolidation is, on the down low. It doesn't make the headlines. It's the small operators going into the larger pools, and it has the same effect as a larger owner controlling a large amount of tonnage. So it's the same effect in the market. And I think as the industry matures, it becomes almost impossible for a smaller owner to operate his own ships on a commercial basis. And the same thing on the technical side. This is a trend we've seen over the past 20 years.
Yeah.
May I also add that because we have been looking at consolidating ourselves with other parties, and we were very close to doing something on the dry bulk side, which didn't materialize due to COVID, which has made things much more difficult. There is this debate on consolidation is quite interesting. My personal view is that even a medium-sized company, a company running 15, 20 ships, can operate very efficiently and compete with the companies that have a larger size, a number of vessels. But that is regarding all the operating costs, technical advantages, commercial advantages. As Bob said, it makes sense to put ships in pools at various points. To be running a company which is, like Starbuck, Hamish, may I say, with 115 ships, if you bring that up to 150 ships, I personally doubt that this will create any additional efficiencies. It might even create some disinefficiencies because of the furtherance of the management from the day-to-day operations. But certainly the one place where being large enough is very important is the stock markets, where you have to have a certain size in order to be able to compete with bigger companies. Our dry bulk company has just 7 vessels, for example. Starbuck has 115. We trade at a small discount to where to NAV, at a bigger discount to NAV than where Starbuck trades. So we are definitely small for a publicly listed company, but a privately listed company with 20 ships might be similarly efficient with a company of 100 ships on every aspect, except perhaps stock market issues.
If I may add one last point,
Please.
I do agree with what everyone has said, but I do think that looking ahead, the new regulatory regime, the requirements of IMO with regard to reduction of greenhouse emissions, the ability to choose between the right propulsion system. Let me give you a simple example. If we say that dual fuel LNG ships is going to be the future, imagine what that would mean for every company that would have to have also in situ gas experts, right? So, I think that given also the changing regime in terms of ESG requirements, and this does not apply only to public companies, I think we might see even further consolidation of the type that Bob described. So not necessarily the big transactions, this happen from time to time, but a simple example would be what happened in Greece. 15, 20 years ago, you had 1,500 ship management companies, now you have 500. And this is not kind of consolidation that's being advertised on the first page of TradeViz. If anything, those type of complications or regulatory requirements, I think they are going to gradually push us into more consolidation.
I'll ask another question that again will have really for everybody to answer or comment on if they would like, and that really relates to the kind of the operating logistics today in the business, which certainly from everything I read and from talking to people understand remain pretty significant when it comes to, I guess, primarily moving crews on and off ships. I'm sure there are other aspects as well. Do you see this being a continuing challenge? Are things becoming easier to manage? How would people comment on that?
It's continuing. I mean, it's the crewing, and the regulations or the rules for each country, each port, change on a regular basis. The logistics of getting somebody on and off a ship or a crew change is expensive. Some of these guys have been out there for a year. You start to head towards one port and the orders change, you go somewhere else. The crew gets restless, it's expensive. There are quarantine issues with the ship itself. In some places, the ship has to wait until the last seaman is on board a plane and the plane takes off. People are tested when they get on a plane towards, say, Singapore to change, and they get tested when they get off the plane again. So you get false positives or false negatives. It's never ending, and it affects all of us. But on the positive side, it makes the industry less efficient, which on an overall basis tends to raise rates because there's less tonnage available.
Anybody else want to comment on that?
I just want to add that to Bob that it is the owner that pays most of this expense for deviation and trying to take care of the crew rather than the charterer. And unfortunately, this is the truth. It is could be considered a bit of unfair kind of turn of events. However, the owner has a duty to complete the voyage and to change the crew sometimes may be absolutely necessary for many, many reasons that I don't even need to discuss right now. And that's really putting the big onus on the owner to take care of the crew. And we've seen instances where the crew has revolted in certain ships or has stopped ships this is, or maybe, the crew has not been paying attention anymore for their job. That's really the risk of not being able to take crews off ships easily.
So continued challenges, and I'm sure that's part of what makes your lives both complicated and interesting. Gents, I think we're going to need to wrap up the panel. So I want to thank each and every one of you for your contributions, for your presence, and for your great insights. Thank you again to Capital Link, to Nicholas, to Eleni, the whole team, and thank you, Shanghai. Hope again it's been a successful and interesting forum. I think we'll sign it off there. Thanks, everyone.
Thank you to everybody. Thank you to say from my end as well to Ted for moderating so well this panel, and to all of you for joining from all over the world. I think modern technology gives us the opportunity exactly to connect globally, and now we can conclude our two-day forum, which has been a highly successful one. And again, not only the attendance, but also the quality of the content and the panelists, and I thank you very much. And now we can all sign off with my tremendous thanks.
See you all in person soon.
Thank you.
Thank you.
See you guys
Bye.
soon. Yeah, that'd be fun. That'd be nice. Take care, everyone.